Welcome to the Luxembourg Fundcast show.
Just a reminder before we start, this podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
All right, let's jump in. Today's deep dive is all about the nuts and bolts of corporate finance documentation in Luxembourg.
Right. We've gathered quite a stack of source material, laws, regulations, market analysis.
And our mission is really to unpack all of that, isn't it? We want to cut through the complexity.
Exactly. For you listening, whether you're deep in the legal side, finance services, or dealing with governance and compliance.
Yeah, if you're navigating this landscape.
We're aiming to lay out the key documents, get a feel for the negotiation process, understand where the costs come from, and map out, the typical timelines for these deals.
So think of this as a curated tour through the official sources. We're not just reading statutes. We're trying to provide a clear analysis.
Making the complex a bit more concrete, hopefully. We'll be hitting those key questions, the who, what, why, where, and how, to really anchor the important practical points.
Okay, let's start right at the beginning. Why Luxembourg? What makes this, relatively small place such a powerhouse in corporate finance?
Well, it's fascinating because, as the analysis consistently shows, it's not really an accident. It's down to a very deliberate long-term strategy.
Oh, okay.
You've got this foundation of political and economic stability, which is huge. But then, crucially, there's a legal and tax framework that's not just sophisticated, but it's designed to be adaptable.
Adaptable how?
It evolves. Plus, you have this deep pool of financial expertise right there. It creates this unique ecosystem.
And the sources suggest it's specifically built for certain users.
That's right. Market analysis points out it's deliberately tailored to fit the needs of investors and securitization vehicles. So it's not just passive laws, it's an active shaping of the environment.
That strategic tailoring really comes through, and its international reach is undeniable.
Oh, absolutely. If you look at the listing data, Luxembourg is a major strategic domicile and listing venue. The Luxus, the stock exchange, is a global leader in international listings.
And they were early movers on things like green bonds, too, weren't they?
They definitely were pioneers there. And another key concept highlighted in market structure analysis is this idea of blendability.
Blendability.
Yeah, Luxembourg solutions are designed so they can slot seamlessly into wider multi-jurisdictional structures. You don't have to do everything in Luxembourg.
Right, you can pick and choose.
Exactly. You might use a Luxembourg SPV for one part, benefit from its specific security laws, or list on the Luxes even if the main loan agreement is governed by, say, English law.
That makes a lot of sense for those complex cross-border deals. So it's not just having good laws, but actively keeping them sharp.
Precisely. The analysis points to this continuous innovation, this proactive adaptation. You see it clearly in cornerstone laws like the securitization law, the financial collateral law.
And even the newer DLT frameworks.
Yes, exactly. The recent updates around distributed ledger technology really underscore this effort to stay at the cutting edge.
Okay, let's dig into that legal and regulatory foundation a bit more. It's this mix of Luxembourg's own laws and then EU rules that apply directly.
That's the setup. It's quite a dynamic interaction. On the purely Luxembourg side, you have some absolutely fundamental laws.
Like the main company law.
Yes, the law of 10 August 1915 on commercial companies, the LCC. It's the bedrock for the main company types, the SA and SARL.
And for finance deals, what does it cover?
Crucial stuff. Share capital rules, bond issuance, which, interestingly, all commercial companies have been able to do since the 2016 change corporate governance. And really importantly, the internal company approvals needed for financing and security deals.
Got it. And then the big one everyone mentions, the financial collateral law from 2005.
Definitely a cornerstone. Legal commentary consistently describes it as highly flexible and creditor-friendly. It covers pledges and title transfers over financial instruments, cash claims.
And the key feature is?
The safe harbor provisions. These are, game changers. They largely shield these arrangements from the usual freezes or stays you get in insolvency. This makes enforcement, especially out of court, much more reliable.
And that's been tested.
Yes, its robustness was underlined recently when the Luxembourg Supreme Court confirmed its broad scope, even in certain cross-border situations. That gives lenders huge confidence.
Right. What about securitization? Is there a specific framework for that?
There is. A dedicated securitization law from 2004. Legal analysis highlights its flexibility. You can securitize a very wide range of assets using these special purpose vehicles, SPVs.
And they have that compartment feature.
Exactly. Segregated compartments. That's key.
Yeah.
It allows an SPV to ring-fence different sets of assets and liabilities. If one compartment hits trouble, it generally doesn't drag down the others.
Yeah.
Risk management gold.
Mm-hmm.
It's also worth noting Luxembourg's own definition of securitization is actually broader than the EU-wide one, which gives it a bit more scope.
Okay, so company law, collateral, securitization. What else forms the pillars?
Well, the law of 5 April 1993 on the financial sector is important. It governs the banks, obviously, but also the many professionals of the financial sector, or PSFs, involved in deals, investment firms, advisors, domiciliation agents.
So it sets the rules for them.
Yes, licensing, conduct rules, their obligations, and it grants the CSSF, that's Luxembourg's main financial supervisor, its powers over these firms.
And for deals involving public markets, the prospectus law.
Correct. The Luxembourg Prospectus Law from 2019. It implements the EU prospectus regulation locally. Crucially, it names the CSSF as the authority that reviews and approves prospectuses.
Okay.
It also sets some specific national rules, like an exemption threshold of EUR 8 million for certain public offers. Regulatory guidance fills in the detail on the CSSF's powers here.
We mentioned DLT. Is there a specific law for that too?
There is. The law of 6 April 2013 on dematerialized securities laid the groundwork. But the big recent step was Blockchain Law 5 in December 2024.
What did that do?
It explicitly amended the 2013 law to confirm that things like equity shares and fund units can now be issued using DLT. It also introduced a specific control agent model for managing these digital securities.
So aiming for more efficiency.
Definitely. The clear goal is efficiency, speed, better traceability using DLT. It really cements Luxembourg's ambition in the digital securities space.
And the CSSF itself, its powers come from?
Its own founding law, the law of 23 December 1998, that establishes the CSSF, defines its mission, and sets out its extensive powers as the main financial supervisor.
So you have this complex web of Luxembourg laws interacting with directly applicable EU regulations.
That's exactly it.
Like the EU prospectus regulation you mentioned?
Precisely. That harmonizes the rules for prospectuses across the EU for public offers and listings, aiming for investor protection and market efficiency, the whole single passport idea.
And MAR, market abuse.
Yes, the Market Abuse Regulation, MAR. It provides that common EU framework against insider dealing, unlawful disclosure, market manipulation, essential for market integrity and keeping investor confidence high.
Any others at the EU level we need to know?
The EU securitization regulation sets key requirements like due diligence, risk retention, transparency for securitizations, and defines those simple, transparent, and standardized, or STS criteria. And then you have MiFID III and MiFIR, which govern a huge range of investment services, trading venues, market transparency rules, and investor protection standards.
Wow, okay. That is quite a layered system.
It is. And navigating that interplay between domestic laws and EU rules definitely requires careful, expert handling.
But there's an underlying intention here.
Absolutely. Looking across both the Luxembourg laws and the EU regulations, the consistent aim is achieving maximum legal certainty and providing really robust protection for creditors and investors. You see it strongly in the collateral law's design and in the CSSF's role overseeing prospectuses. This focus reduces legal risk and significantly boosts Luxembourg's appeal.
It certainly sounds like a regulatory environment that doesn't stand still.
Yeah.
What are some of the really significant recent changes or things on the horizon that are shaping the market?
It's definitely dynamic. On the domestic front, there was the law of 7 August 2023 on business preservation. That brought in the EU restructuring directive, introducing new preventative reorganization procedures.
Did that weaken the collateral law protections?
That was a key question, but subsequent clarifications confirmed that, generally speaking, the core strengths and protections of the collateral law for secured creditors remain intact. So a big change, but core principles held.
And at the EU level, there's a big push to simplify listings.
Yes, the EU Listing Act, adopted late last year. The stated goal is to make EU listings simpler, especially to help smaller and medium-sized enterprises, SMEs, access capital markets.
How does it do that?
It directly impacts the prospectus regulation. It increases some of the thresholds where you don't need a full prospectus. For example, offering new shares similar to existing ones, the exemption threshold went up from 20% to 30% of existing capital. And for certain types of notes offered by banks, the public offer threshold went from EUR 75 million up to EUR 150 million.
And Luxembourg's reflecting that.
Immediately. We've already seen the Luxie update its rulebook to incorporate these higher thresholds.
So the aim is less paperwork, lower hurdles.
That's the driving force. The Listing Act package also includes tweaks to MARE and MiFID II. For instance, under MARE, the European regulator ESMA is looking at extending the simplified format for insider lists previously just for SME growth markets potentially to all issuers. That could reduce admin burdens significantly.
And on the digital side, that Blockchain Law 4 from December 24.
Yes, amending the dematerialized securities law, explicitly bringing equity and fund units onto DLT, introducing that control agent model. It's a clear signal facilitating digital securities issuance and management, aiming for, speed, efficiency, maybe lower costs, reinforces that digital finance ambition.
The Luxess has also been active with changes this year.
Very much so, especially in early 2025. Besides aligning with the Listing Act thresholds, they launched a brand new segment in March, the Euro MTF Specialist Securities segment, or EM3S.
EM3S, what's special about that?
It's tailored specifically for instruments aimed only at professional investors. The big advantages are enhanced confidentiality. No public disclosure of listing documents is required, and crucially, no formal prospectus approval from the CSSF is needed for admission.
Wow. So that speeds things up.
Hugely. Admission is designed to be very swift, potentially just 2 or 3 days after submitting the application. It's a targeted move for the professional market's need for speed.
Any other Luxie initiatives?
They've also enhanced their fast lane admission process for debt listed on the Euro MPF. For example, an issuer that already has shares listed on an EU-regulated market might now be exempt from needing formal CSSF prospectus approval for his subsequent debt listing on the Euro MTF.
So we're seeing EU-wide simplification drives and specific Luxembourg initiatives running in parallel.
Exactly. And alongside these big legislative changes, you always have the CSSF issuing circulars. These are vital. They provide guidance on how to implement EU rules locally or clarify specific Luxembourg requirements.
Like on what topics?
All sorts. Recent ones cover things like remuneration rules for investment firms, guidance on money laundering and terrorist financing risk factors, the technical details for submitting prospectuses electronically, how MAR's rules on delaying disclosure work in practice, and detailed guidance on disclosure requirements under the prospectus regulation. They're essential reading.
And anti-money laundering, AML, that continues to be a huge focus.
Absolutely. The EU is significantly beefing up its framework, new AML regulation, 6th AML directive, and setting up a new central EU anti-money laundering authority, AMLA, in Frankfurt. The CSSF is known for its rigorous enforcement in this area already, so this translates into continuously high expectations for due diligence and compliance in all financial transactions here.
Finally, ESG seems to be everywhere now.
It really is woven into the fabric. Sustainability disclosure requirements are increasingly finding their way into corporate finance documents. ESMA has issued guidance on how ESG factors should feature in prospectuses. Plus, EU laws like the Taxonomy Regulation, the Corporate Sustainability Reporting Directive, CSRD, and the upcoming Corporate Sustainability Due Diligence Directive, CSDDD, are imposing significant new reporting and due diligence obligations that inevitably impact financing deals.
And Luxie's.
Even the Luxie's own corporate governance principles for listed companies now explicitly include sustainability elements. It builds on their early leadership in green bonds.
So the overall trend is complexity.
It's a convergence, really. Traditional supervision, market conduct rules like MAR, disclosure rules under the prospectus regulation, they're all getting increasingly intertwined with ESG considerations. This means more detailed due diligence, more sophisticated risk assessment, and more extensive reporting are becoming the norm in corporate finance.
Okay, let's shift from the landscape to the actual paperwork. What are the core documents, the building blocks in a typical Luxembourg corporate finance deal?
Well, you'll always find a specific suite of documents, and it's really tailored to the deal debt or equity, public or private, secured, unsecured, cross-border. It really reflects that flexibility we talked about.
Can we group them into categories?
Broadly, yes. You usually start with preliminary documents. These kind of set the stage. Think term sheet, letter of intent, heads of terms. They sketch out the main commercial points, usually non-binding at this stage. And the mandate letter, which formally appoints the banks or advisors leading the deal.
Okay, then the core contracts.
Right, the main financing agreements. For debt, that's likely a loan agreement or credit facility agreement. Very often, these are based on standard forms from the Loan Market Association, the LMA, which are widely used internationally.
And for equity or bonds?
For equity, it'd be a subscription agreement or share purchase agreement.
Sure.
For bonds, you'd have the bond terms themselves, maybe set out in a trust deed or a fiscal agency agreement, defining the bondholder rights and issuer duties.
And security documents, you mentioned how key they are in Luxembourg.
Hugely important, especially given the collateral law. These give creditors rights over specific assets if things go wrong. If the assets are in Luxembourg, like shares in a Lux company, Lux bank accounts, receivables located here, the security docs will almost certainly be under Luxembourg law to get the full benefit of that regime.
What kind of security docs?
Things like pledge agreements over shares, accounts, receivables, even a whole business undertaking. You can also use title transfers for security purposes under the collateral law. For real estate, it's mortgages, and those uniquely require a notarial deed in Luxembourg. And of course, guarantees from third parties are very common.
For public deals, you need the disclosure docs.
Exactly. Primarily the prospectus, which is mandatory for public offers or listings on regulated markets and needs that CSSF approval. For deals exempt from that, like private placements, you'd use an offering memorandum or private placement memorandum, similar information but without the full regulatory scrutiny.
What else holds it all together? The supporting cast.
We call those ancillary documents. This is a broad category. Includes things like intercreditor agreements, absolutely vital if you have different layers of debt, to sort out who gets paid first and who calls the shots in distress.
Right.
You absolutely need corporate authorizations, the formal board minutes, and maybe shareholder resolutions proving the company approved the deal. Legal opinions from the lawyers confirming everything's valid and enforceable, confidential fee letters spelling out advisor fees, hedging agreements, often using standard ISDA forms, and usually a very detailed conditions precedent checklist to track all the things needed before funding can happen.
So you see that blend, again, international standards, like LMA for the main contract, but then Luxembourg law specifically for the local security.
That's a very common and practical structure. You leverage globally accepted frameworks where possible, but ensure your local security is rock solid under the powerful collateral law. There's a table in our source material that gives a good overview of these document types.
It seems like a mountain of paper. Why is each specific document necessary? Can't some be combined?
Well, each really serves a distinct but interconnected purpose. It's all about building layers of legal certainty, ensuring enforceability, and allocating risk clearly.
So the preliminary docs, the term sheet.
Even if non-binding, they're crucial for establishing that initial meeting of minds, creating a roadmap, and fleshing out potential deal breakers early on saves time and cost later.
And the main agreements, loan or bond terms.
They define the absolute core legal obligations, repayment terms, interest, covenants, the fundamental promises and protections for both sides.
Security docs are the safety net.
Precisely. Their sole purpose is to mitigate the lender's credit risk. They provide that clear path to recover value from specific assets if the borrower defaults, leveraging those efficient collateral law mechanisms.
Prospectus is all about the investor.
Investor protection, absolutely. Mandated disclosure under regulations like the prospectus regulation for public deals ensures transparency and provides a basis for informed decisions.
And the intercreditor agreement keeps the peace between lenders.
Exactly. Especially in complex deals with senior and junior debt, it's vital to pre-agree the rules of engagement priorities, enforcement rights to avoid damaging disputes later.
Corporate authorizations sound like basic plumbing, but critical.
Non-negotiable. They are the proof the company itself legally sanctioned the deal and the signers had authority. Without them, the enforceability of everything else is questionable.
And legal opinions wrap it up with a bow.
They provide that independent legal verification capacity, enforceability, valid security. Missing any of these pieces or drafting them poorly just invites legal uncertainty and weakens protections. It's a carefully constructed jigsaw.
Okay, it clearly takes a whole team to put these deals together. Who are the key players typically around the table?
It's a diverse cast, often with a strong international element reflecting Luxembourg's role. At the center, you have the issuer or borrower, the entity raising the money. Could be an operating company, but very frequently in Luxembourg, it's a holding company or a dedicated special purpose vehicle, an SPV.
Providing the money.
The investors or lenders, banks, investment funds, private equity, bondholders, a wide range. Then you have the financial intermediaries, arrangers, lead managers, underwriters. They structure the deal, advise the issuer, manage the syndication or underwriting process. Often these are PSFs regulated by the CSSF.
And parties providing support or guarantees.
Yes, any guarantors providing credit support and security providers pledging assets. In syndicated loans, you'll need a security agent or trustee to hold the security for all the lenders. The collateral law makes this straightforward. For bonds, a fiscal agent or paying agent handles payments.
What about the admin side for those Luxembourg entities?
Domiciliary agents or corporate services providers are essential for the ongoing life of SPVs and holding companies, and absolutely critical across the board. Legal advisors, counsel for the issuer, for the lenders, for the arrangers. They draft, negotiate, do due diligence, provide opinions. Luxembourg legal expertise is indispensable.
Can't forget the accountants.
Auditors are key, especially for public deals, needing audited or reviewed financials for the prospectus. And the regulators themselves are active participants.
The CSSF and the Luxie.
Exactly. The CSSF supervises the financial firms involved, reviews and approves prospectuses, enforces market rules like MAR. The Luxie manages its markets, sets listing rules, admits securities to trading. Their direct involvement shapes the process for regulated deals.
Any other internal players?
Shareholders might need to give specific approvals, depending on the transaction. And the board of directors or managers have huge responsibility approving terms, authorizing signing, ensuring disclosure accuracy. In securitizations, you also have the originator selling the assets, and maybe a fiduciary representative. It's a busy table.
Looking at these documents, where are they typically governed and enforced? Is everything under Luxembourg law just because the company might be registered here?
Not usually, no. Luxembourg takes a very pragmatic approach here, balancing international market practice with local legal necessities. For the main financing contracts, big syndicated loans, international bonds, it's very common to see English or New York law chosen as the governing law.
Even with a Luxembourg borrower?
Yes. Market analysis shows international financiers often prefer the deep body of case law and perceived predictability of those systems. Luxembourg law respects this choice under EU rules on freedom of contract.
But that changes for the security documents.
Almost always, yes. If you're taking security over assets located in Luxembourg shares in a Lux company, a Lux bank account, maybe local real estate, those security documents will be governed by Luxembourg law.
Why the switch?
It's essential to ensure the security is validly created. Perfected meaning made enforceable against third parties and can be effectively enforced under the local system. Crucially, it lets you tap into all the advantages of the Collateral Law 2005.
So local law for local assets makes sense.
Definitely. And for specific Luxembourg aspects within, say, securitization documents, like the legal status of the SPE, how compartments are segregated, the company's center of main interest for insolvency, Luxembourg law applies there too. And prospectuses, as we said, fall under both EU and Luxembourg prospectus law, overseen by the CSSF.
And where do disputes end up? Which courts?
The contracts usually specify the courts of the governing law country through jurisdiction clauses. However, Luxembourg courts will have jurisdiction over matters governed by Luxembourg law enforcing security over Lux assets, resolving local corporate law disputes, or handling insolvency proceedings for a Lux entity.
How about enforcing foreign judgments in Luxembourg?
Judgments from other EU countries are generally enforceable relatively easily under EU regulations. For non-EU judgments, it depends on specific treaties, but Luxembourg courts can refuse enforcement if it clashes with fundamental Luxembourg public policy.
So this split international law for the main contract, Luxembourg law for local security, that's a deliberate strategy.
Absolutely. Legal commentary and market practice highlight this bifurcation. It lets parties get the best of both worlds. A familiar, predictable international framework for the core commercial terms, combined with robust, efficient local security under the powerful collateral law. It needs careful coordination between lawyers in different jurisdictions, but it's a key element of Luxembourg's appeal. Party choice is paramount, but those mandatory Luxembourg rules and public policy act as a backstop.
How are these complex documents actually put together and signed off? What's the process?
It's a very structured, often intense process. It blends international best practices with specific Luxembourg requirements. The actual drafting is led by legal counsel, typically the lender's lawyers for a loan, or the issuers or arranger's lawyers for bonds and prospectuses.
Do they start from scratch?
Often not. Standard forms, like the LMA documents for loans, are frequently used as a starting point, but, and this is crucial, they are then heavily negotiated and tailored to the specifics of that particular deal, the borrower's situation, the agreed risks.
So lots of back and forth.
Definitely. It's iterative. Drafts fly back and forth, track changes, review calls, comments from all sides. Findings from the due diligence process feed directly into the drafting, influencing things like the reps and warranties or specific covenants.
And the actual signing ceremony? Or is it less ceremonial now?
It can be less ceremonial, often done electronically, but the crucial point is who signs. It must be individuals formally authorized by the company. That's why getting those internal corporate authorizations, the board minutes, maybe shareholder resolutions locked down before signing, is absolutely fundamental for validity.
Are there special formalities in Luxembourg? You mentioned notaries.
Yes, for certain key corporate actions or documents, a formal deed before a Luxembourg notary is mandatory. Things like incorporating a public or private limited company, SA or SARL, formally amending their articles of association, or creating a mortgage over Luxembourg real estate. That's a strict requirement.
But other documents can be signed electronically.
Increasingly common, yes. Luxembourg law permits electronic signatures under the EU's EIDAS framework for many agreements. After closing, there are also follow-up steps filings with the Luxembourg Commercial Register, RCS. And while the collateral law simplifies security perfection by focusing on control rather than public filing for many assets, you still need to take the specific steps required by the law to make that security effective against everyone else.
So it's a collaborative effort needing both international and local know-how.
Absolutely. You can use international standards as a base, but you absolutely need sharp Luxembourg legal input to nail the local requirements, authorizations, security perfection details, regulatory compliance, and those specific formalities like notarial deeds are rigid. Getting them wrong can cause serious problems. Strict adherence is key.
Okay, let's really get into the nitty-gritty now. We should look at some specific critical clauses from these documents, try to break them down: who, what, why, where, how. This is where the real deal mechanics live, right?
Absolutely. Zeroing in on these key clauses reveals how risk is managed, how obligations are defined, and often reflects lessons learned from past issues or market practice. It's where the legal strategy really plays out.
Great. Let's start with a standard loan agreement, maybe one based on those LMA principles. First up, conditions precedent, or CPs.
Great, CPs. Let's break it down. Who? Primarily, the borrower is responsible for satisfying them. The lenders are the beneficiaries. They need confirmation before funding. What are they? There's a specific list of conditions that absolutely must be met or formally waived by the lenders before any money can actually be drawn down.
What's typically on that list?
All sorts. Executed copies of all the finance documents, favorable legal opinions, proof that the security has been properly perfected, up-to-date financial statements, confirmation there's been no material adverse change, MAC, in the borrower's business, payment of upfront fees. It can be quite extensive.
Why are they so critical for the lenders?
They act as the lender's final checkpoint. It ensures all the fundamental legal and commercial prerequisites are demonstrably in place right before they release the funds. Minimizes risk at the point of maximum exposure.
Where do you find them in the agreement?
There's usually a dedicated clause in the main body, but the detailed list itself is often tucked away in a schedule. Satisfying all CPs is what gets you to financial close.
And how does it work in practice?
The borrower gathers and provides evidence for each item on the list. The lender's legal counsel then reviews everything meticulously. The exact scope and timing of CPs are often negotiated upfront. If a CP can't be met on time, the borrower has to request a formal waiver from the lenders.
Okay. Next, representations and warranties, the R&Ws.
R&Ws. Who makes them? Primarily the borrower, sometimes guarantors too. The lenders are the ones relying on their truthfulness. What are they? They are statements of fact made by the borrower about its legal status, its business operations, its financial health, things like confirming its proper legal existence, that it has the power to enter the loan, that its financial statements are accurate, that it's complying with laws, including crucial areas like anti-money laundering and sanctions, and critically, that no default situation currently exists. These are usually made at signing and often repeated at key moments, like each time funds are drawn.
Why include these detailed statements?
Several reasons. They provide the lenders with a verified snapshot of the borrower's condition at critical points. They clearly allocate risk, the borrower is warranting these facts are true. And importantly, if a representation turns out to be materially false, it usually constitutes an event of default, giving the lenders specific remedies.
Where are they located?
In a dedicated, often quite lengthy section of the loan agreement, their accuracy is vital at signing and any funding dates.
How are they typically handled?
Standard LMA forms provide a comprehensive baseline. However, borrowers will negotiate the precise scope, seeking qualifications based on materiality thresholds or limiting statements to their actual knowledge. But a material breach is a serious matter, often leading straight to an event of default.
Covenants seem central to controlling risk after the deal is signed.
Absolutely. They govern the borrower's behavior throughout the life of the loan. The borrower must comply. The lenders monitor compliance. What are they? They are promises. Affirmative covenants are promises to do things, provide regular financial information, maintain the company's legal existence, comply with laws and pay taxes, keep adequate insurance.
And negative covenants.
Those are promises not to do certain things without the lender's permission. These often include restrictions on taking on more debt, giving security to others, the negative pledge, selling off important assets, making certain investments, fundamentally changing the business, or paying dividends above agreed levels. And then you have financial covenant-specific financial ratios like leverage, interest cover, the borrower must maintain, tested periodically.
Why are these so heavily negotiated?
Because they represent the core tension between the borrower's need for operational flexibility and the lender's need to protect their investment and ensure repayment. They aim to keep the borrower financially healthy and stable. Financial covenants act as crucial early warning signs if things start to deteriorate.
Where do they apply?
They are effective from signing right through to final repayment, central to the ongoing relationship.
How does the negotiation play out?
Intensely. Borrowers push for flexibility in negotiating baskets or permitted allowances for things like debt or disposals and seeking headroom in the financial ratios. Lenders push for tighter controls. Compliance is tracked through financial statements and compliance certificates. Breaching a covenant after any allowed grace period is typically a major event of default.
Which leads us directly to events of default, EODs.
Right, EODs. Who? Triggered by the borrower's actions, inactions, or sometimes external events like insolvency. Who benefits from them? The lenders gain critical rights. What are they? Specific events listed in the agreement that, if they happen, empower the lenders to take drastic action.
Like what kind of action?
Canceling any remaining commitment to lend, demanding immediate repayment of the entire outstanding loan, acceleration, and crucially, moving to enforce their security over the pledged assets. Common EODs include failure to pay principal or interest, breaching a covenant, making a false representation, entering insolvency proceedings, defaulting on other significant debts, cross-default, the loan becoming illegal, or a major negative change in the borrower's condition, a MACPI clause.
Why is this section so critical?
It defines the ultimate remedies for the lenders when the deal goes significantly off track, where the borrower fails fundamental obligations. It outlines the triggers for potentially ending the lending relationship and starting recovery actions.
Where does it sit in the deal structure?
It's a central, heavily scrutinized section. And its interaction with Luxembourg security is vital. As we discussed, the collateral law is flexible, allowing enforcement triggers to be any other event whatsoever as agreed, meaning the security can be directly linked to the loan agreement's EODs.
How are EODs negotiated?
The LMA provides a standard comprehensive list. Borrowers will fight hard for grace periods for certain breaches, materiality thresholds, and try to narrow the scope, particularly of things like cross-default clauses. Wording and scope are always intensely debated.
Okay, one last bit on the loan agreement. Governing law and jurisdiction.
Who does it affect? All parties. What does it do? It clearly states which country's law will be used to interpret the contract, often English law for LMA-based deals as mentioned, and which country's courts will have the exclusive right to hear disputes arising under that agreement. Why specify this? To ensure legal certainty and predictability. International lenders often prefer well-established commercial law systems. Where is it? Usually towards the back in the boilerplate section, but it's absolutely fundamental. How is it decided? Usually driven by the lenders or established market practice for that type of finance.
That covers the loan mechanics well. But as you stressed, security is king in Luxembourg, especially thanks to that 2005 collateral law. Let's pivot to a security agreement, maybe a pledge under that law.
Good idea. And it's worth repeating. The collateral law is a huge part of Luxembourg's appeal for secured deals.
Yeah.
That combination of flexibility, strong creditor protection, and efficient out-of-court enforcement that's largely insolvency-proof. That's powerful. And the Supreme Court's recent confirmation of its broad reach just solidifies that.
So in a pledge agreement under this law, what's the absolute first step?
The creation of the security interest itself. The pledger, usually the borrower or owner of the asset, grants the pledge. The pledgee, the lender, benefits, or often a security agent acting for a syndicate of lenders, which the law explicitly allows. What is it? A clear, unambiguous statement in the agreement legally creating the pledge, or gage in the legal term, over specifically identified assets, shares, accounts, receivables to secure clearly defined obligations, typically everything owed under the main loan. Why? To legally establish the security right. Where? It's the core operative clause. Must comply with the collateral law's requirements. How? Precise drafting, identifying assets, and secured debts is key. The law requires the agreement to be in writing, allowing clear identification of the pledged assets.
Then comes perfection, making sure it actually works against others.
Absolutely critical. This is where the collateral law gets interesting with its focus on dispossession or control. Who needs to act? The pledger, the pledgee, and sometimes third parties like banks holding pledged accounts or company registrars for shares. What are the requirements? These are the steps needed to make the pledge enforceable against third parties, and most importantly, to make it stand up in an insolvency situation. The law requires the written agreement plus effective dispossession or control.
What does dispossession or control mean in practice?
It varies by asset. For registered shares, it usually means recording the pledge in the company's share register. For a bank account, it means notifying the bank where the account is held, getting their formal acknowledgement is best practice, and establishing the pledgee's control over the funds. For book entry securities, it might involve crediting them to a specific pledged securities account controlled by the pledgee.
Why is this perfection step so vital?
It establishes the pledgee's priority over any later competing claims to the same asset and is the key to the pledge surviving the pledger's potential insolvency. Where does this happen? The obligation is in the agreement, but the actions, notification, registration, transfer happen outside the document itself. How? Procedures differ for each asset type. The collateral laws focus on control rather than just public registration for many financial assets is a key streamlining feature. But getting these practical steps exactly right is absolutely crucial.
The scope of secured obligations, ensuring the security covers all the debt.
Right. Who defines this? The clause spells out which of the pledger's debts to the pledgee, or the secured parties, are covered by the collateral. What does it cover? Typically drafted very broadly. All amounts due under the main financing principle, interest, fees, costs, indemnities, everything. A key flexibility in the collateral law is that it allows security for future debts as well as present ones, and can benefit future beneficiaries too, as long as they're identifiable. Why define it broadly? To make sure the collateral genuinely covers the full extent of the potential liabilities arising from the deal. Where? It usually cross-references the main financing agreement to define the debts. How? Broad language is standard, but clear cross-referencing is essential.
And the crucial part, enforcement rights. What happens when things go wrong?
Who acts? The pledgee, or the security agent, exercises these rights once an agreed enforcement event occurs. What methods can they use? The ways the creditor can actually realize the value from the pledged assets on default. And here, the Luxembourg collateral law is particularly powerful. It provides for flexible, creditor-friendly, and crucially out-of-court enforcement methods unless the parties specifically agree otherwise in the pledge.
Why is out-of-court so important?
Speed and efficiency. It avoids potentially lengthy and costly court procedures, provides diverse ways to recover value quickly. Where do these rights apply? They kick in upon an enforcement trigger. As we noted, the law allows this trigger to be any other event whatsoever as agreed, so it can perfectly mirror the events of default from the loan agreement. How does enforcement work? The pledge agreement details the specific methods chosen within the law's parameters. Options include the pledge appropriating, taking ownership of the asset if a valuation method was agreed, organizing a private sale, selling via auction or on a stock exchange, or applying to court for attribution based on an expert valuation. For cash claims, set-off is also possible. That concept of achieving dispossession or control is really the bedrock of the collateral law's effectiveness. While simpler than some older systems, the specific practical steps needed vary significantly by asset shares versus accounts versus securities, and implementing them correctly is absolutely vital for the pledge to work as intended against third parties and in insolvency.
Okay, let's look at a third key document type, the prospectus, needed for public offers or listings on regulated markets.
Right. Prospectuses are heavily regulated territory governed by the EU prospectus regulation, the Luxembourg prospectus law, plus lots of detailed guidance from both the CSSF and ESMA. The main goal is high investor protection through standardized, carefully scrutinized disclosure. Though the recent EU Listing Act is trying to ease the burden somewhat, the CSSF's review role is absolutely central here. They perform a substantive check.
First thing you usually see is the responsibility statement.
Yes. Who takes responsibility? Primarily the issuer company and its board of directors. Sometimes others involved, like the entity offering the securities of different... What is it? It's a formal declaration, usually right up front, stating that to the best of their knowledge, all the information in the prospectus is accurate and complete, and crucially, that nothing significant has been omitted that would affect its meaning. Why? To establish clear legal liability for the content. It's the foundation for potential investor lawsuits if the prospectus proves misleading. Where? Prominently displayed near the start. How? The wording is largely standardized, mandated by Article 11 of the prospectus regulation.
The summary is also mandatory, isn't it?
Yes, a key requirement. Who? Prepared by the issuer, aims squarely at investors, especially retail investors. What is it? A concise overview, key info about the issuer, the securities, any guarantors, and the main risks. The regulation is very strict on its content, format, and length, usually capped at 7 A4 pages. Why have a summary? To give investors a quick snapshot, help them understand the basics, and decide if they want to delve into the full document. It has to be understandable on its own. Where? Right at the beginning. How? Highly regulated content and format under Article 7 and related rules. ESMA Q&As provide lots of guidance. Must use clear, non-technical language.
Risk factors always a section investors should read carefully.
Absolutely critical. Who identifies them? The issuer must conduct a thorough assessment. They are vital for investors. What are they? Descriptions of the material risks that are specific to this issuer, its industry, its financial situation, or the securities themselves. Regulators emphasize limiting this section to genuine material risks ordered by importance. Generic boilerplate risks are strongly discouraged. Why? To ensure investors are aware of potential downsides and uncertainties, enabling a balanced investment decision. Where? A dedicated, prominent section, subject to close CSSF scrutiny during approval. How? Requires careful, honest assessment by the issuer. Risks should be categorized, and descriptions must be specific, explaining how that risk could impact the issuer or the investment. Materiality considers both the likelihood of the risk occurring and the potential size of its negative impact.
Financial information is obviously core.
Fundamental. Who provides it? The issuer. Annual financials must be audited by independent auditors. Interim financials must be reviewed. What's included? Historical financial data, typically the last 3 audited years, usually under IFRS or an equivalent standard. If the prospectus comes out more than 9 months after the last audited year-end, interim financials, usually covering the first 6 months of the current year, are also required. Pro forma financials might be needed if there's been a major acquisition or disposal. Why? Allows investors to assess past performance, current financial health, cash flows critical for valuation, and assessing the ability to meet obligations. Where? A major substantial section. How? Must strictly comply with detailed rules in the prospectus regulation and related acts. ESMA Q&As clarify many points.
Finally, use of proceeds. Telling people where the money's going.
Exactly. Who discloses? The issuer. What's explained? A clear statement on how the net proceeds from the offering will be used. If funds are for specific projects, those should be described. Why? Transparency for investors. They need to know the purpose of the financing. Where? A specific section within the main body. How? Should be as specific as possible. If it's just for general corporate purposes, that needs to be stated clearly. This section gets particular focus for green or social bonds, requiring detailed info on the eligible projects being funded.
That gives us a really solid grasp of the framework, the documents, the key clauses. But these documents don't write themselves, they emerge from negotiation. Why is negotiation so critical in these deals?
Oh, it's about much more than just haggling over the interest rate. Negotiation is fundamental. It's how you take a standard template, like an LMA agreement, and tailor it precisely to the unique commercial realities and risks of this specific deal and this specific borrower.
Customizing the standard model?
Exactly. It's essential for defining and allocating risk, who bears responsibility if X or Y happens. It's where you hammer out the precise economic terms, beyond the headlines, all the fees, how ratios are calculated, payment mechanics. There's always this inherent tension.
Between borrower flexibility and lender protection.
Precisely. The borrower needs room to run their business while the lender needs comfort. Their investment is safe and will be repaid. That plays out heavily in negotiating covenants and default triggers. Negotiation is also vital for ironing out ambiguities in the language, making sure everyone's on the same page to avoid disputes later. It transforms a generic structure into a bespoke solution reflecting the actual commercial deal within the complex legal and regulatory context, especially somewhere like Luxembourg. The bigger or riskier the deal, the more intense and crucial the negotiations.
Who are the main people doing this negotiating?
You've got dedicated teams on both sides, blending commercial, financial, and legal skills. On the issuer or borrower side, senior management CEO, CFO, treasurer typically lead the commercial strategy. In-house legal coordinates internally and advises management, working closely with external legal counsel.
And the external lawyers are key.
Absolutely critical. They draft, review, advise on legal risks, ensure compliance, including specific Lux law points like security perfection, and lead the detailed legal negotiation. As the sources stress, being well advised is paramount. Financial advisors might also be involved on strategy and market terms.
What about the lender or investor side?
Similar structure. You have the deal team or relationship managers leading commercially and assessing credit risk. In-house legal oversees external counsel and manages internal compliance. External legal counsel for the lenders often takes the lead, drafting the initial loan documents and negotiates hard on their client's behalf, focusing on risk mitigation and robust security. And behind them, internal credit or investment committees wield significant influence based on their risk appetite.
Any other negotiators involved?
Yes. Arrangers or underwriters negotiate with the issuer first, then potentially with the wider syndicate or investors. Security agent counsel reviews the agent's specific duties. And remember, given Luxembourg's blendability, you often have multiple law firms coordinating across jurisdictions, maybe English law counsel for the facility, Luxembourg counsel for the security. It requires real teamwork.
So what specific terms usually cause the most debate? Where are the battlegrounds?
It varies, of course, but some areas are perennial hotspots economically. The obvious ones: interest rates, margins, fees, arrangement commitment, prepayment penalties. For equity deals, the valuation and dividend policy are key.
And on the control and flexibility side, that seems like prime negotiating territory.
That's where much of the heavy lifting happens in the legal docs. Conditions precedent their scope, timing, materiality, representations and warranties their breadth, qualifications, how often they're repeated. But covenants are usually the most intensely negotiated area.
Financial covenants especially.
Yes. The specific ratios, definitions, calculation methods, testing frequency, the amount of headroom allowed, any rights to cure a breach with equity, huge focus there. Information covenants, what needs reporting, and negative covenants, those restrictions on debt. Security, the negative pledge, asset sales, investments, business changes, dividend caps are fiercely debated. Borrowers push for baskets and carve-outs to maintain flexibility.
What else gets heavily scrutinized?
Events of default definitions, grace periods, materiality thresholds, the scope of cross-default triggers, the security package itself, exactly which assets are covered, ranking, release conditions, scope of guarantees. In complex deals, intercreditor issues ranking, payment waterfalls, standstill periods, enforcement rights are critical and complex. Governing law jurisdiction is usually market standard but needs agreement. And prepayment redemption rights and associated costs are always negotiated.
Where does all this intense negotiation actually happen? Is it still smoky back rooms?
Less smoke, maybe, and fewer back rooms. Physical meetings still occur, sure, at offices in Luxembourg or London or wherever. But increasingly, the negotiation happens in the virtual environment. Drafts exchanged by email, countless conference calls, video meetings. But the most important where is probably the legal space, the framework set by the chosen governing law, English, New York, Luxembourg for security, shapes the entire discussion. Local corporate law requirements also play a role based on where entities are domiciled. So communication is often virtual, but it's grounded in specific legal frameworks.
How does this whole negotiation process get structured and finally concluded?
It's typically a phased, iterative process, moving from broad principles to fine legal detail. Starts with preparation and origination, identifying the need, selecting advisors, agreeing the mandate.
And the initial terms.
Phase 2, structuring, due diligence, mandate, detailed transaction design, thorough DD by all sides, negotiation of the high-level term sheet or LOI, and signing the formal mandate letter appointing the lead bank's advisors.
Then the lawyers really get busy.
Phase 3, documentation, often the most time-consuming. Drafting the main agreements, security docs, intercreditor, maybe prospectus. Multiple rounds of review, comments, negotiation calls and meetings, clause by clause, often runs in parallel streams for different documents.
And if it's public, regulators step in.
Phase 4, regulatory approvals and marketing syndication. Submitting draft prospectuses to the CSSF, responding to their comments, applying for Luxy listing. Simultaneously, maybe syndicating the loan to other banks or marketing the securities via roadshows.
What are the final hurdles?
Phase 5, internal approvals and signing. Getting those final, formal board and shareholder resolutions. Finalizing documents based on last-minute points, then formal execution by authorized signatories. Phase 6, closing and funding. The big day. All CPs are satisfied or waived. Final closing docs, including legal opinions, are delivered. Security is perfected. Then funds flow from lenders, investors, and securities are issued, delivered. Phase 7, post-closing. Necessary filings, transition to ongoing compliance, reporting, debt service, etc. It's a sequential process. Early agreements shape later stages. A failure to agree on a fundamental point, even late on, can cause major delays, extra cost, or even kill the deal.
Let's switch gears to the money side of things, the costs.
Yeah.
Why do these transactions inevitably rack up expenses?
Well, fundamentally, you're paying for a whole ecosystem of specialized services needed to structure, document, regulate, and execute these often very complex deals. You're compensating the financial intermediaries, arrangers, underwriters, advisors for their structuring work, market access, distribution efforts. That comes in the form of various fees.
Legal fees must be a big chunk.
Indispensable and usually significant, yes. You need expert legal counsel for drafting, negotiating, due diligence, navigating regulations, providing those crucial opinions. Due diligence itself has costs paying accountants, lawyers, possibly commercial consultants to thoroughly vet the borrower and the deal risks.
And regulatory bodies charge too.
Yes, direct regulatory fees are payable to the CSSF for prospectus approval and to the Luxy for listing. Plus, there are indirect costs in preparing all the documentation to meet their standards. Risk assumption is also priced in somewhere, reflected in interest margins or fees.
What about setting up the structures?
Admin and structuring costs, definitely. Especially with the common use of SPVs in Luxembourg, you have setup costs, ongoing domiciliation fees, accounting fees. And security perfection isn't free. While registry fees under the collateral law can be minimal, you might have notary fees for mortgages or costs for asset valuations. Basically, the more complex the deal, the more parties, the more regulation, the higher the costs.
Who generally picks up the tab for these different costs?
Market practice is pretty clear here. The issuer or borrower, the entity raising the capital, bears the overwhelming majority of the costs.
So they pay their own advisors and the lender's advisors too?
Typically, yes. They cover their own legal, financial, accounting fees, and they usually reimburse the reasonable legal fees of the lenders and arrangers, though this reimbursement is often negotiated and frequently capped. Arranger underwriter fees, financiers' due diligence costs, regulatory fees to CSSF and Luxy, security perfection costs, notary fees, printing, it's almost all borne by the issuer.
So lenders mostly just cover their internal team costs?
Generally, yes. Lenders and investors cover their internal deal, team time, and analysis. They might absorb external legal costs above a negotiated cap paid by the borrower. The return comes primarily through interest, dividends, or capital gains. It's rare for core costs to be shared. It reflects the reality that the borrower is the primary beneficiary seeking funds. Negotiation usually centers on the reasonableness of third-party costs, especially those lender legal fees.
Can you break down the typical cost components we might see?
Sure, though it varies hugely. Big items include financial advisory arrangement, fees arrangement, underwriting placement fees, often a percentage of the deal size, quite negotiable. Advisory fees for strategic input, legal fees covering the issuer's lawyers, the lender's investors' lawyers, reimbursement often capped, arranger's counsel, plus any specialist tax or regulatory advice. These can be substantial. Due diligence costs, fees for accountants, lawyers, other specialists doing the vetting.
Specific Luxembourg costs.
Key ones are the regulatory fees. CSSF charges for prospectus review. A 2021 regulation set fees like €12,500 for a URD review, plus percentage fees based on offer value for notes. The Luxembourg has its own initial listing and annual fees, varying by market and security type. Agency fees are ongoing costs for paying fiscal agents bonds, security agents trustees, facility agents loans, auditing fees for the necessary audits or reviews of financials. For rated deals, rating agency fees can be significant. Notary fees for those mandatory Luxembourg beads, incorporation mortgages, etc., based on official scales. Then you have printing, distribution, publication costs, and miscellaneous like travel, translation. While Luxembourg aims for tax efficiency on the deal itself, minimal registration duties, VAT on services still applies.
Okay, our source material has a helpful table on this. Where are these costs actually incurred and paid? Does it all happen in Luxembourg?
Rarely. Reflecting the international nature of the deals, costs are incurred globally. Legal financial advisor fees are incurred where they're based. Lux, London, New York, etc. Regulatory fees are paid in Luxembourg. Printing might be done anywhere. Payment usually flows from the issuer or borrower, often netted from the deal proceeds at closing, going out to service providers in their home jurisdictions. So cross-border payments are common.
How can companies try to manage or estimate these potentially large costs?
Planning and negotiation are key, as many costs are variable. Strategies include getting competitive quotes when selecting advisors, negotiating fee structures, hourly rates versus fixed or capped fees, especially pushing for caps on reimbursed lender legal costs. Efficient project management helps providing info promptly. Making decisions quickly avoids wasted advisor time.
Does using standard documents help?
Using standard forms like LMA as a starting point can streamline drafting, yes. Clearly defining the scope of work for advisors upfront is crucial. Consulting official fee schedules from CSSF and Luxembourg helps budget regulatory costs accurately. Staging due diligence, agreeing cost allocation clearly in the mandate letter, using technology like data rooms, these all contribute. Proactive planning and understanding the components are vital for estimation and control.
Let's talk about the final piece, the timeline. Why is getting a handle on the timeline so critical?
It's not just admin. It's a core strategic element. It dictates effective planning and resource allocation, getting internal teams and external advisors lined up. It ensures alignment with business objectives the financing needs to land when the acquisition closes, the project starts, or the old debt matures. For public deals, market timing can be crucial, hitting a good window. It helps manage stakeholder expectations, keeping the board, shareholders informed, and critically, it allows for coordination of multiple work streams running in parallel: DD, docs, regulatory, marketing. Delays anywhere can have serious commercial fallout, missed opportunities, higher costs, unfavorable market conditions. So managing the timeline diligently is key risk management.
Who's actually driving the timeline at different points? Is it the borrower?
It's really a shared responsibility, with different parties taking the lead at different stages. The issuer borrower sets the initial goal and needs to provide information quickly and make decisions promptly. Their proactivity is crucial. The lead arrangers, financial advisors, underwriters often drive the overall process, managing structuring, syndication marketing, coordinating documents. Legal counsel on all sides drive the documentation drafting and negotiation. Their efficiency is paramount.
And the regulators have their own pace.
Exactly. Regulatory bodies like the CSSF for prospectus approval and the LuxF for listing admission represent critical path items with their own review timelines. These timelines must be factored in realistically, although initiatives like eProspectus and Luxie's Fastlane M3S aim to speed things up where possible. But because it's a chain, a delay by any one party impacts everyone. Communication and coordination are everything.
Can we break down the typical phases of a deal timeline?
Generally, yes. Phase 1, preparation and origination. Internal needs analysis, contacting advisors, selection, mandate negotiation. Phase 2, structuring, due diligence, mandate confirmation. Detailed deal design, comprehensive DD, negotiating the term sheet lie, signing the mandate letter.
Then the heavy documentation phase.
Phase 3, documentation, drafting main agreements, ancillary docs, prospectus if needed, intense negotiation, auditor engagement. Phase 4, regulatory approvals and marketing syndication, submitting to CSSF LuxS, responding to comments, while simultaneously syndicating the loan or marketing the securities.
Nearing the end.
Phase 5, internal approvals and signing, getting final board shareholder green lights, finalizing documents, formal execution. Phase 6, closing and funding, the finish line. CP satisfied waived, final docs opinions delivered, security perfected, funds dispersed, securities issued. Phase 7, post-closing, filings, ongoing compliance reporting, debt service begins. The documentation and regulatory approval phases, 3 and 4, often take the longest due to the sheer detail, number of parties, negotiation time, and the structured regulatory review. There's a timeline illustration in the sources for a typical public debt deal.
Where do the biggest potential delays, the critical path items, usually lie?
Often with external dependencies or complex internal steps. Regulatory approvals are huge ones for public deals. CSSF prospectus approval time, Luxembourg submission process. The quality of submission and responsiveness matter, but review takes time. Using a URD can help repeat issuers sometimes.
What about external parties causing delays?
Definitely. Getting third-party consents from existing lenders or key counterparties can sometimes drag. Security perfection, even with the efficient collateral law, can hit snags with complex assets, cross-border elements, or slow third parties like account banks. Unexpected due diligence findings can halt everything while issues are resolved. Negotiation impasses on key terms are obvious roadblocks. And surprisingly often, the simple availability of key individuals for meetings, approvals, or signings can become a bottleneck. Those external factors, regulators, third parties, are often the least controllable and pose the biggest timeline risk.
So realistically, how long do these transactions usually take? And what makes one deal fast and another slow?
There's huge variation. Just as illustrations based on market insights, a simple bilateral loan might be done in weeks. A more complex syndicated loan or a private placement could take 2-4 months. Public bond issues or IPOs needing a full prospectus, often 3-6 months, sometimes longer. That's driven by the extensive disclosure, drafting, CSSF approval process, and marketing time needed. But Luxembourg does offer faster tracks. That Luxi EM3S segment aims for 2-3 day admission for specific professional deals. The fast lane process can exempt certain debt issues from full prospectus approval. These show a clear effort to facilitate quicker access where appropriate.
What are the main factors influencing that duration?
Key drivers include the deal's complexity structure, security package. The type of transaction public deals inherently take longer due to regulation. Prospectus regulatory review is often the biggest time sink if required, the number of parties involved, and their responsiveness. Quality and availability of information for DD prevailing market conditions. Experience of the advisors, whether it's a first-time issuer versus a repeat issuer who might use a URD. And overall jurisdictional complexity. Even with efficient local mechanisms like the collateral law or Luxi fast tracks, complex public offers under EU rules like the prospectus reg inevitably take substantial time.
Okay, let's wrap this up. Thinking about everything we've discussed, what are the absolute key considerations for anyone navigating corporate finance documentation in Luxembourg?
I think the main takeaways are, first, appreciating that unique dual legal framework, understanding how Luxembourg's own strong laws, LCC, collateral law, securitization law, interact with overarching EU regulations, prospectus reg, MAR. It's dynamic. Second, the need for precision and thorough negotiation documents need meticulous drafting to reflect the commercial deal and allocate risk correctly. Third, the strategic importance of governing law and jurisdiction choices using international standards where appropriate but leveraging Luxembourg law, especially for local security, to ensure enforceability. Fourth, regulatory compliance is non-negotiable. Adhering strictly to CSSF rules, prospectus, market conduct, and Luxes requirements listing is fundamental. Fifth, proactive cost and timeline management, having realistic expectations and managing critical paths, especially regulatory reviews. And finally, adaptability. The landscape keeps changing with EU and local updates. Listing Act, Blockchain Law 4. Staying informed is crucial for compliance and spotting new opportunities like streamlined listings.
Looking ahead then, what are the big trends or developments we should keep an eye on?
The evolution will continue, driven by tech, regulation, market demands. Digital finance and DLT are clearly a major strategic push for Luxembourg. That Blockchain Law 4 signals commitment. Expect more tokenized securities, new digital infrastructure, and evolving documentation practices around that.
The Listing Act's impact.
That will continue to unfold. We'll likely see more use of the simplified prospectus rules, potentially boosting SME listings, and the MER amendments should ease compliance burdens.
And ESG. Is that just going to get bigger?
Undoubtedly. The primacy of ESG seems set to intensify. It'll be even more central in investment decisions and mandatory disclosures. Demand for green sustainable finance will drive development of specific documentation standards and increase scrutiny on ESG claims. Luxembourg's leadership in green bonds positions it well.
Anything else on the regulatory front?
Enhanced AML-CTF scrutiny is definitely coming, with the new EU rules and the central AMLA authority. Expect even more rigorous due diligence and compliance focus in Luxembourg. And overall, expect continued regulatory adaptation from Luxembourg itself. They have a history of proactively updating laws to stay competitive. So we'll likely see targeted changes responding to EU moves and market needs. It's this interesting tension, isn't it? Increasing complexity in areas like AML and ESG, running alongside concerted efforts to simplify processes like listing rules. Navigating that successfully will require real expertise and foresight to keep leveraging Luxembourg's strengths.
Lots to think about there. Definitely hit that like and subscribe button if you found this deep dive helpful.
And the final reminder, this podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
It was the Luxembourg Fundcast podcast for you today.